Half an hour away from the opens in Hong Kong, Shenzhen and Shanghai, you're watching The China Show. I'm Yvonne with Annabelle Droulers.
Our top stories: Asian equities rise after stocks and bonds rally on Wall Street as investors await Friday's U.S. jobs report. Traders almost fully pricing in a Fed rate cut this month.
Chinese stocks remain in focus with corporate earnings pointing to a fragile rally as authorities move to slow the gains. We're speaking to CLSA and BofA about their outlooks this morning.
Plus, our scoop on how China's DeepSeek is working on an AI model with more advanced features to compete with U.S. rivals. Well, coming into the morning session, I think you can see here there's really a fair bit of positivity across the screen. Strong session on Wall Street overnight. We were just talking about how you had those moves in stocks and bonds, but it is that anticipation of what we see for the jobs report coming up. We'll get more on that, of course, the movement that we've seen, yields pulling back at the short end of the curve. But generally what you've got for equities today is that movement to the upside, watching the Nikkei in particular because it has been leading in the session so far. President Trump, as we were just saying there, has signed that executive order to implement the Japan trade or tariff deal as well. Taiwan also moving a little bit to the upside here. Again, maybe it's more of that movement back into tech. Actually, speaking of tech, we had President Trump, for instance, just in the last hour or so, hosting a range of different big tech CEOs at the White House, but certainly making that point that the US, he says, is leading in AI. What's interesting, of course, is DeepSeek. We had that scoop that they're looking to release an agentic AI model. But let's take a look, as I said, at what's happening in the bond space, because it has been that move back down in yields a little bit. We've got the 2-year yield here sitting around its lowest point in a year. It's that expectation. We get that jobs report coming up. But so far, what we've had in private payrolls data, what we've had in the JOLTS data as well, really tells us that that Fed rate cut is pretty much fully priced in right now. It's only going to be perhaps a really hot inflation print later this month that could test that case as well. So that's what we're seeing here for yields, again, mostly retreating at the front end. Shifting now to the outlook for Chinese markets, we are looking to a little bit of upside at the open. As I said, that scoop we had on DeepSeek preparing an agentic AI tool. It's going to be an interesting one, I think, for markets. We might see some movement, given that we've had so much optimism around, R1, of course, for DeepSeek in January, but just any sort of updates we get from DeepSeek can be enough to sort of spark a rally in equities. But at the same time, what does this also mean for the likes of Alibaba?
Yeah, certainly that the AI race continues to heat up. And I think any sort of update from DeepSeek is something that is quite sensitive to the market right now. We saw that with that update just a few weeks ago. So certainly we'll see what this agent and what it can actually mean in terms of AI capabilities and the like. So certainly that's one potential catalyst here today amidst this sort of stock sell-off that we saw yesterday, where we basically saw 1 to 2% losses there when it comes to Hang Seng as well as in onshore markets here. So we'll see if we see day 2 of that after what our scoop had mentioned there, that regulators are looking for some cooling measures to kind of slow down this rally. There's a CGB sale here today. We talk about tech stocks, given what we're seeing overall in the region and the U.S. We might see a different story today, just given that China has been heading the opposite direction from the rest of the world as of yesterday. Capricorn, that's the one to watch as well. It was a 14, I believe, % drop yesterday. That was the most in nearly 8 months as well. So that's still that wariness over the recent surge in tech stocks. That certainly is still a key focus here. And we're still watching oil today, of course, as we get into that OPEC meeting this weekend as well. But yeah, it brings a lot of discussion here on where do we stand now in this whole liquidity-driven rally.
Yeah, exactly. I think what's been sort of the most interesting thing is that you've continued to see that divergence, optimism around stocks, but question marks or concerns around the US economy, and also what kind of theme would develop out of earnings, and would that be enough to justify another leg higher? But actually, when you take a look at what we've seen so far, it's combined losses actually for earnings in the latest period as well. I think you're looking at non-financial quarters, for instance. That's a combined loss. Overall, some gains, but muted when you look from the quarter prior.
Yeah, the China second quarter has been quite telling so far, right? You're not seeing maybe the justification for this rally. As you mentioned, the non-financials have underperformed because of stubborn deflation and the like. But when you look at financials, you look at AI-related themes, those still remain those rare bright spots. And it's a lot of why investors are saying, I still have reason to stay in this market because of all the different themes out there. I don't have to really focus too much on the macro right now.
Yeah, let's get more on this story now. Bring in Shaun Cochran. He's head of research at CLSA. And Shaun, thanks for joining us in the studio. And I think we can let you lead the conversation here. What's sort of standing out to you right now? And what are you noticing the most in markets today?
Well, the conversation you're just having is really it, which is there's this real conundrum, which is if we look at the macro, we've got the US as this big leading economy that's just generally slowing down. But the recession that people thought might come years ago, including myself, never came. And so the market has just kept moving forward. So the question is, what's really driving the US leadership and how does that relate to China? If we think about the US leadership, we've got an environment where it's really some dominant stocks that's dragged the market higher, and it's a dominant theme, which is that with the rise of AI, you get this enormous capex boom, which is a huge part of GDP growth. It's the most volatile part of GDP, and it just sustains that underpinning where the economy is, in aggregate, actually okay, but large parts of the economy are not enjoying the benefits of that rise, and so you get this sort of bifurcation of the performance and the confusion. Just why is the market up yet the macro is mixed? So that gives you the American side of the equation. And the Chinese side is similar in that if we look at where China started, I was here some time ago where we talked about we were quite bullish on China, not because the market was doing well, it had just become so cheap. So we have to remember part of China's excellent performance over the last 12 months is really because it was a very cheap market, and when markets become that cheap, so little expectation in prices, then of course flow will move in that direction. So that's helped China, but equally the DeepSeek moment opened the world's mind to could China play a fundamental role in this new AI theme.
Regulators are trying to at least slow the rally, as we've been reporting as well. Do you think it's going to work, or do you think this could actually spark some sort of deeper correction?
Yeah, look, if we look at the state of the rally, our technician is fundamentally bullish on China, feels that it has broken out, and we had these cheap sort of valuations to start it, which means we are not yet into expensive territory such that you would have to worry. The market has been very much about some liquidity support. As you've mentioned earlier, there's not strong, pervasive fundamentals across the entire economy doing exceptionally well. It's about the steady improvement and the removal of the concern that China was going to have a meaningful slowdown. Now, if we combine it with this AI improvement, then you get this concentration of performance where people get quite positive about the tech sector, less negative about everything else, and it can drag the whole market up.
We've got this chart here behind you, and it's talking about that US cumulative fiscal deficit.
Yeah,
I mean, how does that also play into what you were saying there about that sort of spending that we see?
So what's really interesting about the nature of how this cycle has evolved is that this has been an incredibly long cycle. It's gone on for well over a decade, which is unusual. And within that, we've had a fundamental transition in what drives liquidity in markets. From the 80s up until the 2000s, it was really a liquidity-driven environment where the changes in the liquidity pricing was fundamentally important to what was driving the market. But since the COVID period, what you can see in that chart is that you have this period where in 2020 and 2021, there's this enormous government spend coming out of the US, and the rest of the world did it, but the US in particular did it at scale. And this was a logical response to this exceptional challenge of the arrival of COVID. That then shifted things in that we had this fiscal dominance narrative that moved, and it moved the Overton window insofar as what's acceptable in terms of how much money a government can spend, which moves us into this fiscal dominance where it's very hard to express the downside, that recession that never came. If there's this wall of spending that continues to come, then it's very hard for that downside expression to come. The usual cycles are not really playing out.
And so what does that lead us when it comes to the curve? I mean, the steepening seems to be the way to express that here right now. We have two-year yields in the U.S. are now the lowest all year. In the past year, I would say. Is that steepening trend, can that continue for
Right,
time?
so there's a couple of dynamics embedded in the shape of the curve, insofar as the long end of the curve has not really come off as much as the growth concerns have slowly built with the passage of time. And the short end of the curve, the expectations continue to build. As you mentioned earlier, there's conviction in the market that a cut is coming in the near term.
Yeah.
So ultimately, that's expressing those two things, which is the short end of the curve is saying the conviction in the quality of the growth is not particularly high. And then outside of that, the long end of the curve is saying we are concerned about the lack of fiscal discipline.
So, I mean, concerns about the lack of fiscal discipline then, and how does that exactly play out, do you think? I mean, you're talking about sort of fiscal spending that continues to come, so you can't have that expression of a downward revision in the economy. But, but I mean, that must reach a head at some point.
Correct, yeah, which is the fundamental question for markets. And the challenge is there was a US technician, Richard Russell, unfortunately he's passed away, but he used to say the market always does what it should, but never when you think it will. So the challenge is these things can just go on far longer than anyone expects. the simple reality is the state of the US fiscal position is such that any sort of real fracture in the immediate term is unlikely. The debt to GDP, the liquidity ratios, we're not clearly at a point where this could really break some sort of treasury price expression. The other thing to remember is if we were to have challenges in treasury markets anywhere in the world, yes, it can express in the relative term structure, so the yield price in the long term and the short term, but it's more likely to express in currencies, especially for the US, insofar as central banks can purchase their own treasuries and manage their treasury markets. Where you're likely to see the capital flow express itself is in the price of the currencies.
It seems like investors have shifted dramatically towards, focus on the labor market.
Yep.
How are we looking at this jobs report? Are we going to be, or should we be worried about more revisions like we saw last month?
Well, I mean, when I speak to my clients, I advise them non-farm payrolls is important insofar as the market will react to it, but there's limited valuable information there insofar as there's much more short-term data these days. We can look at all sorts of sites that can provide us that. I personally find the initial claims far more useful because it's subject to less revisions. It's more frequent in terms of the data. But ultimately, it's back to the original point, which is there's this slow deceleration going on in the state of the US economy. We've got the pushing of this continued spend, which means it's not accelerating to the downside, which would normally be the usual cycle. And we should expect that it continues to decelerate. Now, importantly, there's a critical mass of jobs that the economy must create. Otherwise, it creates problems. Unemployment will go up, and that will trigger a cycle. And that is ultimately going to happen, back to your question, when. And so that's why I look at the initial claims. The longer you do this, the more you don't know, and the more you don't want to get too confident that you can predict the future. It's a probabilistic game where we have to think of all the possibilities and weight our portfolio towards the more likely ones that are not expressed in the price.
Okay, Shaun, we'll have more on what's not expressed just yet. Shaun Cochran there, head of research at CLSA. And still ahead, Morgan Stanley breaks down their new report and why household deposits, they say, aren't exactly flowing into equities as quickly as some have anticipated. They just came back from their mainland trip as well. Xing, their chief China economist, joins us later on. And we are counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. As we wrap up this trading week, certainly has been a big one about diplomacy, military might in China as we wrapped up this military parade. Futures, though, seem to be suggesting we might see a bit of a good day today. This is Bloomberg.
We're making it very easy for you in terms of electric capacity and getting it for you, getting your permits. We're leading China by a lot, by a great amount.
That was President Trump there speaking at a White House dinner earlier alongside US tech leaders. It was, of course, an event early today in Washington at the White House, but it was jam-packed, star-studded. You can see Mark Zuckerberg there, but there was Bill Gates, there was Tim Cook, there were the heads of Oracle, AMD. You can see Lisa Su there in that blue suit. But a really big meeting, essentially, and it comes, of course, amid competition between Silicon Valley, Chinese tech champions. And on that point, from the China side, Bloomberg's learned that China's DeepSeek is developing a new model with advanced AI agent features to compete against US rivals like OpenAI. Sam Altman actually was in attendance as well. But let's dig into this with Newly Purnell, our tech reporter. And this is a big one, really, because they have had the R1 model. We haven't really seen anything major from DeepSeek since then. So what do we know about this agentic AI tool?
Yeah, right. I mean, this is DeepSeek, to go back to the beginning of the year, they kind of surprised the world when they released this LLM that seemed to be pretty much as good as a lot of the U.S. Versions, and it was for a developer a fraction of the cost. So what they've said now, some great reporting by our colleague Sarita Rai, saying that they're working on an agentic AI software that could be released by the end of this year. And what it would be designed to do is compete with the likes of OpenAI and some of these other providers into what's seen as kind of the next phase of generative AI, some of these agentic AI services that can go out and do things for you, not just spit back text to you like an LLM, but go out and do things. So pretty exciting.
For the non-techies out there like myself, Newly, can you explain what an AI agent is and why are people so excited about them?
Yeah, it's sort of a fancy word for AI that can actually do something in the real world. So an LLM like ChatGPT or DeepSeek You enter text, it spits back text based on its computations. The idea with agentic AI is it actually acts as an agent for you. You can ask it to, and I've done this, I reviewed another service, Manus, a Chinese-founded service based in Singapore, and the idea is you ask it to do something, it will open a browser or something in the cloud that can go out and scan the web, compile information for you, maybe even buy things online for you, make bookings, compile stuff into a spreadsheet or a PowerPoint presentation and give it back to you. So the idea is it's actually like an assistant, like an agent for you that can go out and do things independently and give it back to you. So you really could see how it could spur some of these productivity gains that people talk about generative AI being able to do.
Yeah, I think that's in that report from Sarita. She was mentioning Goldman Sachs saying that would be sort of the next leg to really spur a lot of productivity. But what does this mean then for the bigger picture? I mean, it's competition that DeepSeek faces in China, but also against others that have released agentic tools too.
Right. I mean, I think it could be, when we see this come out, it could be another moment where people say, well, look at all the money that OpenAI and Google and Microsoft and Anthropic and others are spending. And if this really small, scrappy startup from China is able to do something that's comparable with fewer resources, it maybe will throw into a question again the power of some of these other competing services with all of the resources and all of the years ahead that we assume that the American AI companies are supposed to be.
All right, thank you, Newly Purnell there, our Bloomberg Asia tech reporter. Still with us is Shaun Cochran, head of research at CLSA. Shaun likes to put us on the spot sometimes and tell us, make this chart now. This is the one you wanted us to make. Our producers were scrambling in the commercial break. Of the NASDAQ versus S&P from 2009 till now. And that tells us a little bit more about where this AI trade goes, I guess. What does it suggest to you?
Well, there's two elements here. There's the fiscal element we talked about a little bit earlier, and then there's that leadership for AI. So if we if we look at that movement in the market, you can see there's been these waves. So the market has a major wave, and then it corrects. Its first big correction was basically as the economy was slowing down, and Trump comes along and says, I'm going to spend money and do tax cuts, even though the economy's okay. It wasn't actually in recession, I'm going to spend. It changed that fiscal narrative we talked about earlier. Then we move up into the COVID period, and we have a massive correction in the COVID period. It doesn't look that big on the chart, but it was quite big at the time.
Right.
And in that environment, you had that big fiscal spend, which further drives this US exceptionalism. And tech becomes the dominant sector to buy because that's the only sector that can operate in that time. Then we have an environment where we have this thought of a big correction. Now, we talked about a fiscal dominance chart earlier in the session, and there it was 2022 where there wasn't much spent. And so that's why you had this huge correction. Two things came along to put a floor in the market. One was that the government just kept spending again, that fiscal dominance returned. But two was the arrival of OpenAI. That gave us that big moment that had the market driving forward, which gave us the capex boom that we see now, which is underpinning the strength of the economy and keeping that market keeping on. The thing that caused a correction not that long ago in the AI sector was the arrival of DeepSeek.
Right.
Insofar as the US corrected because China came along and showed, oh, we can do this too. And that opens some fundamental questions about how do I think about AI? And there's lots we can unpack in there in terms of foundational models versus the layers and the agentic layers on top. And where is the competitive advantage?
Let's dig into that then,
okay.
because I think that's the point. I mean, you know, that theory makes sense in the sense that, yes, you spend more, so you get more ROI, and
right.
that makes sense for that US dominance story. But if China can do more for less,
right.
What does that tell you then? And where's the sort of strengths that you see in the Chinese AI landscape?
Okay, so this is the fundamental question. How do we unpack it? Because we have released a big report recently. So this time of year is important for us. It's the 32nd CLSA Investors Forum. For that, some of our analysts released their big reports of the year. One of the biggest reports for us was the tokens tale, which talks about how many tokens, which is the fundamental unit of compute in AI, do you need in the future? Today, we're running at about 1 quadrillion a month, so crazy numbers.
Yeah.
And our analyst believes that goes to 80 quadrillion a month. And that's his best guess. We don't really know, is the reality.
Yeah.
However, that's a huge demand for tokens. Now, in terms of how do we process those tokens, we use GPUs, TPUs, these fundamental units of compute. But then there's productivity gains. Now, just the chips themselves should get something like 27x better over the next decade. So almost halving the amount of compute required to deal with those tokens. But then there's also what DeepSeek does, which is algorithmically, how do I approach the software in order to be able to do things fundamentally more efficiently. So they're breaking down into, we talked about the agentic units, different parts of AI that might call on a smaller model, which consumes less tokens, to answer the same question, but not only answer the same question with less tokens, but answer it with more precision, which improves the efficiency of AI. So this is the journey that we're going on. And so you can understand that incredible volatility in a stock, in these AI stocks. I've had some skepticism myself. And my
Look at Capricorn.
Right. So
didn't talk about it a month ago.
Right. So ultimately, there's so many open questions, and it's understandable that you'll get a very wide range of opinions because the variables are so wide.
Shaun, really great having you on this morning. That was Shaun Cochran, their head of research at CLSA. And just as we've been speaking now, we've had a breaking headline crossing the terminal here, but Canada is looking to scrap its EV sales mandate and also launch a regulatory review. So we'll get more details on that just ahead. But just to recap, Canada looking to axe its 2026 EV sales mandate. Plenty more ahead as we look ahead to the opens in mainland China and Hong Kong. Futures are pointing to a little bit of upside here at the open. Also seeing the yuan there, offshore yuan, pretty steady. More ahead. This is Bloomberg.
All right, we'll finally see if we see a second day of the sell-off that we're seeing across mainland markets. And certainly one thing to watch yesterday was really this week alone, really, was what we saw in the Chinex, right? RSI levels basically reached 86 on Monday here. That's the fourth highest overbought sort of level we've seen on record. So that goes to show, yes, it's easy to tell why maybe regulators want to slow down this rally, right? But if you take a look at how, whether this sort of engineering of a slow bull market can actually work or be successful, take a look at history. The China Today column highlights this, right? So history suggests that it actually might be effective. You take a look at past rallies, right? Everything from 2013 up until now, when you have seen a 1 month return of about 20%, about a month after that, about 21%, you do 21 days, I should say, you do average a return of about 4%. So it has happened in the past that we can actually start to maybe cool things down a little bit as well. But then again, you take a look at this whole, what's really been driving the gains in this equity market, and it might be what we're seeing in the bond market, right? There is no alternative to, you can't buy property at this moment given how weak the market is. Therefore, I'm going to put my money out of bonds into stocks. That is one of the big factors of why we are seeing these inflows into the equity market. You take a look at how yields go and how this equity market has gone. And if that earnings yield is still about 4 basis points higher than where bonds are right now, analysts are saying that might be more reason for next leg to come. The open is next. This is Bloomberg.
Welcome back. You're watching the China Show this morning. We're counting down to the open of markets. Yesterday, it was the reaction we saw to the Bloomberg scoop that we had around looking at measures perhaps to try and cool down the equity rally. We've got Xing from Morgan Stanley in the studio with us, just making the point that maybe the market correction was enough, that it's sort of been self-done already, and regulators can maybe just pull back a little bit for now. No need for any excessive measures.
Yeah, he just came back from the mainland, so we'll be getting his takeaways coming through here. But yes, as you say, the rest of the world is actually reacting to the weak U.S. jobs data that we got overnight, and that really kind of maybe bodes well for this jobs report coming on Friday, that maybe, the almost 100% certainty now that maybe the Fed could cut. That's what markets are pricing in right now because of what we've been seeing, cracks in this labor market. So certainly that is going to be the big thing here. But right now, this cooling of this equity market, which we saw yesterday, was quite telling, right, from our Bloomberg scoop, that they want to find ways to, at least on the edges, slow things down here. That certainly maybe is working here right now, at least for a second day. We are seeing a slow going here so far on onshore markets there. But at one point, we did see the Shanghai Composite falling the most since like a few days after Liberation Day back in April. So that stabilized a little bit here today in the China session here on Friday. Shenzhen is doing decently well. We're up about 0.1%. And of course, we're watching some of the gauges like Starboard 50, which really did see a lot of losses there yesterday. We're up about now 0.5%. Capricorn is certainly one thing to watch here after that, 14% drop yesterday as well. We are seeing a little bit of stabilization there in the stock here as well. Of course, a lot of the hot money was going into stocks like Capricorn, like Queqiao Maotai of late in this A-share market. So at least for those both, looking decently better here than yesterday. And we're watching very closely what bond markets are doing here right now. Not much movement there. That 30-year is still well below, slightly above that 2% level here as well. But as we talked about, right, it is the lows that we're seeing in these bond market yields, bond yields, that is really kind of catapulting the flows into this equity market. And you're still seeing Hang Seng doing decently well. We're up about 1/5 of 1%. HS Tech seems to be doing modestly higher. Tencent is up some 1% as well. So a bit of a recovery there in Hong Kong here this morning. Key to watch, of course, is going to be the EV sector, right? So the Reuters reporting just after our show yesterday that a BYD is maybe considering cutting their sales target by 16%. So that sent a lot of questions, right? Is this EV price war coming to an end when you have the likes of BYD cutting sales production, the number one in the market, of course, right? So we'll watch the EV space here today. But Alibaba is down about 0.8 of 1% as well. There was these kind of talks about DeepSeek, and our sources telling us they're working on a new AI agent here in this whole kind of race with AI. So certainly that could be a catalyst for some of these AI stocks here today as well. That's why we're seeing maybe the chips are doing okay. If you take a look at SMIC, we're up about 2% in Hong Kong today. And of course, we are watching very closely China autos, right? So we talked about BYD. We're going to get Bloomberg Intelligence coming through here. Shirley Wong has been kind of crunching the numbers and looking at really what this means in this whole price war, right? BYD there, we see the stock recovering. We're up about 0.4 of 1%. But yes, the likes of the auto doing okay. We're up 2% here right now. Belle.
Yeah, let's also talk about what's been a rare meeting, actually, between Chinese fiscal and monetary policymakers. That's also been prompting speculation that easing measures could be on the cards. Let's get more with our senior executive editor, John Liu, joining us from Beijing. And John, I mean, who was in this working group, and what were some of the key takeaways as well?
So this working group was led by a deputy finance minister, Liao Ming, and also a deputy central bank governor. It's not the first time that this group has met. It was designed to better coordinate monetary and fiscal policy and the response that we've been getting from Beijing to the economic slowdown. And as we've been talking about, the market has gone up substantially over the last month or so, but it's only going to be sustainable if you have economic growth and corporate earnings backing it up. And so far, the economic data that we've gotten in August for July was still relatively weak. We're going to get more data later in this month. Next week, CPI and trade. Week after that, retail sales, industrial production. And that's really going to tell us where this economy is going. And that I think, is what this meeting is really focused on.
Does that give us any sort of signals of where policy and where stimulus could be? I mean, there's a lot of questions about how much room there is fiscally for the government now.
I mean, if you'll remember back in September of last year at the very end of the month, we had that really unusual press conference with the central bank governor where there was a bevy of new measures announced, cuts in the reserve requirement. We saw the regulatory bodies really step up to the plate and start launching new efforts to prop up the economy. That, I think, is not incoincidental because at the end of September, you have a sense of how the economy is done for the first 3 quarters, and you have a sense of how much the government needs to do to get to that about 5% GDP target that they've set for 2025. And so I think there is a little bit of looking forward in terms of getting ready in case the economy needs an additional boost. This meeting would set the table for doing that.
John, thank you. John Liu, our executive editor there, about this rare meeting that we just saw in China. And Morgan Stanley was just coming through here on a trip from the mainland here and really kind of gauging what's been on the ground. Robin Xing, chief China economist, joins us now. Takeaways from your trip to Beijing and Shenzhen.
Hi, Yvonne. Let's recall what we discussed about 1 month ago in your show. Liquidity was in driver's seat. We have seen some kind of water buffalo forming. So that liquidity, that narrative was dominating basically every single speaker on your show in the last month or so. But we have also warned about a month ago there is a disconnection between fundamentals and this liquidity narrative. August prints are very soft. High-frequency data like housing, exports, fiscal impulse are all fading. So back to fundamentals, I would argue what happened in the market is more like a reality check. It's not a broad reflation yet, and we have seen that modest policy moves, as your colleague John in Beijing mentioned, some marginal easing in monetary and fiscal policy, but these are more cyclical tools which can cushion. To have a new cycle, you need structural moves to anchor reflation and rebalance. That's not these marginal easing tools. That's probably the upcoming fourth plenum and the 15th five-year plan outlines. That's the key swing factor we are monitoring.
What's the likelihood, though, that we get anything major from that? I mean, a lot of people have been saying also the rally that we've seen in Chinese equities has sort of removed some of that need as well for big stimulus measures.
Well, I would argue they need to reflate the economy with much stronger consumption-centric policies. For example, if they use the five-year plan to change the government incentives, to recalibrate the fiscal policy, to put all these resources into a stronger social safety net, that could unlock consumption in a more sustainable way. So that's the five-year plan to be announced by the fourth plenum. That's the key swing factor. Before that, we will keep hearing incremental, modest cushion measures, be it this fertility support or subsidy on services consumption, or some accelerated pace on vetted infrastructure spending. But these are more like providing a cushion.
There was this sort of meeting that the CSRC Wu Qing had with industry experts and the like recently. And what do you think has changed in terms of how regulators looking at this rally? Because, up until now, it seemed like they were focused more on stability, especially amid the face of tariffs and the like. And now you're seeing even like policymakers nudging towards a stronger RMB to help with inflows in some ways to the equity market as well. Has the role of the equity market changed from a policymaker's point of view?
Well, I think policymakers probably see the equity market as a very, very excitable dog on a very long leash. So it does, on random directions, but eventually the policy guardrails, which is the leash, can bring it back. So what happened over the last 2 months, the debate over liquidity-driven market, the so-called deposit migration thesis every speaker on your show mentioned, I would taper expectations because the size of this excess saving in the last few years is probably smaller than most people imagined. Only in RMB, 6 to 7 trillion excess time deposit over the last few years. And more importantly, the pace of migration outflow into equity is much slower than the market imagined. July, August, probably only 300 billion yuan migration at best. So it's quite slow. Why? Because many market entrants in 2021, they are still underwater. That precautionary saving is still elevated. So I think back to fundamentals, you need broader reflation that pulls through to wages, to employment. That can make this rally much more sustainable. And for policymakers, the signal has been providing guardrails, not bricks. So they probably act earlier, more targeted than previous boom-bust episodes. So now they are using some pro-market reforms plus some window guidance to provide guardrails. I think that's not bricks. And the market, as you mentioned, kind of did the self-correction by itself. So heavy-handed intervention is not necessary.
It's interesting as well. I mean, yes, maybe it's more led by smart money, less by sort of retail money. That's sort of the theme that's come out. But also the questions around what is the next leg of the rally, and the earnings results we've seen don't really justify any big move higher from here. When you also combine it against stories like Yvonne was saying about Reuters reporting that BYD has cut their sales target for EV sales. I mean, that's not a great signal either about the health of the economy. So, I mean, how much worse do you think the economy will perform going into the end of the year?
Well, we have a soft second half forecast. And more importantly, deflation is going to be persistent. So China started this anti-involution campaign, and we did a deep dive solar sector is probably exhibit A for anti-involution. There seems to be a plan starting with upstream, like polysilicon, with a consolidation plan financed by some industry funds to absorb inventory, to smooth the supply curve. But solar is probably the most easier one. If you look at the downstream, cars, e-commerce, express delivery, these are much tougher because the fragmentation of market share, because policymakers have less policy levers on these sectors. So it's not going to be easy. It's more like a messy path, maybe 2 steps forward, 1 step back, that kind of path, rather than a straight line for reflation. Our base case is Chinese growth will still be with subdued nominal growth, deflation throughout maybe the end of next year. But if you talk about micro story, because Yvonne, you mentioned our trip in Beijing and Shenzhen, there's some divergence in Shenzhen. It's all positive micro story. Things like the green tech, EVs, and the transitions like power storage, power grids, and also the smart manufacturing, like using AI and the industrial robotics and the software that make them more efficient, improving cost benefits. And last but not least, these new so-called new productive forces, humanoids, self-driving cars, and AI adoption. You also mentioned the DeepSeek new model. So I think there is a lot of micro positivities. It's just that these are not enough to have a full pull-through to wages and employment for reflation, not yet.
You mentioned that fiscal expansion is limited. Why do you think there's not that much room? And how bad does it have to look for the economy in the fourth quarter to actually spark some sort of fiscal expansion, do you think?
Well, the reason is simple. With the first half GDP tracking at 5.3%, for Beijing, the bar for much bigger deficit expansion or much more aggressive rate cuts is quite high. It will be data dependent. And if the third and fourth quarter data softened more than they expected, it's possible they will do some monetary and fiscal easing in Q4. But again, these are more incremental targeted easing, like cyclical tools providing a cushion rather than using structural reform to anchor rebalance. That's the 5-year plan, the fourth plan. Before that, I think any additional fiscal easing will be quite modest.
Robin, thanks so much for joining us this morning. That was Robin Xing there, Chief China Economist at Morgan Stanley, and taking you to some live pictures now from Tokyo because we have a meeting underway between Australia and Japan. This is the 12th Australia-Japan Foreign and Defence Ministers meeting that's taking place today. So Australia's Penny Wong, that's the Foreign Affairs Minister, also the Deputy Prime Minister, Minister for Defence Richard Marles, meeting with Japan's Minister for Foreign Affairs and also the Minister of Defence, But the focus here is on shared geostrategic priorities, increasing collaboration as well across some critical areas like economic ties, cybersecurity, regional security as well. But we leave you there with those shots as we can see Japan and Australia defence meeting underway this morning. We'll have plenty more ahead. This is Bloomberg. Some of the stories that we're tracking this morning, and VinFast shares closed lower in the US. That's after reporting a deeper loss in the second quarter as global expansion costs continue to climb. Loss for the period widened to about $770 million. That's 15% more than the previous quarter, and that's even as revenue jumped 92% from a year ago. The EV maker inaugurated a factory in India last month and expects to open another plant in Indonesia by October. Proton, the Malaysian car maker backed by China's Geely Auto, launched its EV production plant on Thursday. The factory is in the northern state of Perak and it marks Malaysia's first foray into EV manufacturing. The $19.4 million facility will have an annual capacity of 20,000 units, with plans to expand to up to 45,000.
All right, and checking now, BYD shares, of course, after we saw yesterday, Reuters reporting that the EV maker was cutting its full-year sales target by 16% due to intense competition in China. So the stock recovering a little bit here today, but certainly it begs a lot of questions on where we are in this price war. Is this a sign that the price competition and the like is maybe coming to an end. Let's bring in the Bloomberg Intelligence's take on this. Shirley Wong, she focuses on thematic investing, and she's with us here right now. Shirley, it's great to have you.
Thank you for having me.
With the news on BYD, it's not confirmed just yet, but does this change your overall view of EVs and your investment theme?
Really the news about BYD softening its demand is really a reflection of the oversupply in the industry that we've seen previously, and also the changing of consumer behavior. Consumers today are looking for luxury experiences and brand innovation. And as well, we've seen that back in July, China embarked on anti-involution campaign to cut, some of to curb some of the price wars that we've seen, and also to curb the excess capacity industry. So that's going to be taking some time to reflect into the company profitability.
You mentioned that shift in consumer behavior. What does that mean for the overall AI industry then? EV, rather.
Yes. I think that with the BYD, they're operating in a very intense competitive environment. We found that companies, electric vehicle companies that are embarked on, R&D development, brand innovation, technological innovation, could fare better in a price war competitive environment. And so some examples would be Xiaomi, Tesla. They've ventured into humanoids, smart technology. Huawei is also making some sort of a high-end luxury SUV, as well as XPeng is also being involved in, eVTOLs or, what they call flying cars. So these are examples of innovation-led growth at these companies.
Yeah, I mean, you specialize in thematic investing, right? So in terms of themes right now, beyond just EVs, you mentioned a lot of those. What are some of the big themes to watch out for?
I think that transition metals is very interesting. It has a lithium component to it, which is critical to the manufacturing of EV batteries. As well, we're seeing, rare earths being a very crucial role in the making of clean technology. So that's one theme that is quite interesting to look at, as well as within the consumer discretionary space. The shifting of consumer patterns. People are spending more on luxury items, on collectibles, and also experiences like traveling, dining out. And we're also seeing them try to improve their well-being and their health, so they're spending more on that as well.
Shirley, thank you. Come back and join us soon on TV. That was Shirley Wong there from Bloomberg Intelligence. And if you're a subscriber and you want to rewatch that interview, rewatch any of our programming, you can also do that via our interactive TV function, TV Go. You can become part of the conversation, send us instant messages during the shows as well. So check it out at TV Go. We'll have plenty more ahead. This is Bloomberg.
Some other stories that we're tracking for you in the tech space today. The Financial Times is reporting Anthropic will stop selling AI services to groups majority owned by Chinese entities, including ByteDance, Tencent, and Alibaba. The report says it's because Anthropic is trying to prevent Chinese tech from benefiting its military and intelligence services. Sources told the FT that the policy will take effect immediately. The FT also reporting that OpenAI is preparing to design and produce its own AI chip with help from Broadcom. The report says the startup intends to ship the first chips next year and would also use them internally. Broadcom CEO earlier told investors a major new customer had placed production orders for custom AI accelerators. Hock Tan also promised big improvements for the firm's AI outlook next year, sending its shares higher after the bell. And Huawei has unveiled a new tri-fold phone, updating its earlier groundbreaking model. The new Mate XTs has two folding mechanisms and can work as a regular smartphone or two variations of iPad-like tablets. It marks Huawei's second effort at a two-fold device after its predecessor was launched last year. The Mate XTs uses Huawei's latest Kirin processor and is priced at $2,500. Kind of pricey there.
It is kind of pricey, but it's actually cheaper than the first one because that was was priced at $2,800. So this is actually coming down in price. But I'm actually really curious to see this in real life.
It's cool.
Last year I went and had a look at the first trifold phone, and at the time it was big and it was cool and it was new, but it wasn't really optimized, the software for a tablet, a screen that big, and it was a little bit glitchy and maybe some questions around the battery life because it's so thin. But this time I'm really curious to see, because they've got their new operating system now as well. They've moved it in-house. They've moved off the Android one to their own Harmony operating system. What does that actually mean? Okay, we've got to move on. We're looking here at what's happening with the sportswear stocks as well.
Because Huawei suppliers, so that
Huawei suppliers. Yeah. Okay, sorry, I wasn't reading. I was just looking at I don't know what I was looking at there. But yes, there's some of the Huawei suppliers there in focus. I mean, kind of mixed moves so far. But we can shift now to the sports stocks, take a look at what's happening with some government policies, because there's been some more support coming out for the sports industry, looking to boost it through consumption, industry development as well, but looking at loans to subsidise interest to sports companies, encouraging incentives as well for local governments to try and boost consumption. I mean, we're seeing sort of that playing out. But also it's interesting to do a bit of a comparison, because we had the Lululemon sales overnight and they weren't good again, really, from the company. So taking a look at that.
It's the tale of two sportswear makers, right? I mean, obviously Li-Ning has done quite well, given some of the government support and the like. You know, this whole kind of shift into more domestic consumption brands as well. But yeah, Lululemon, they were talking about really getting hit by this de minimis, rule here. So certainly that took a hit for the earnings. And yeah, stock still needs time to recover there. We have the next hour coming up. Welcome back to the China Show. Here's a look at the CSI 300, a half hour into the session here right now. And we are looking decently well. We're 0.5% to the upside here. So we're coming back from what was a pretty steep sell-off yesterday on the back of our scoop that maybe policymakers are looking at ways to slow down this rally. It seems to have worked at least for a day. And things are stabilizing a little bit here on this Friday morning. But certainly, yes, a lot of questions on what's the next leg. Earnings haven't been too good so far if you look at everything beyond financials and AI-related things. So certainly we're still looking for those catalysts out there.
Yeah, exactly. I mean, that's sort of been that was the key test, or a key test. You know, how would earnings perform? And actually, they've come in weaker than they were in the period prior. But it was interesting yesterday. You're sort of mentioning that market reaction we had to our Bloomberg scoop. Say the CSI 300, 250 stocks were in the red. There was 50, say, that were either steady or moving higher. But if there was one sector that was standing out, it was the solar one yesterday, because we were seeing these big moves to the upside for solar names led by Dacao. And that was after we had a Bloomberg interview talking about, with the CFO of the company, but talking about how they were calling the bottom for the market. And this is sort of, when we were just speaking with Robin Xing about this from Morgan Stanley, but this is sort of priority one, or the first point, that we're starting to see really anti-involution policies take effect, and they've got a plan to clear out the glut and also to have some consolidation, I guess, in the sector. So that's the solar stocks. You're continuing to see another day of gains here. But let's also take a look at what's happening with the Philippine peso today, because we had inflation accelerating in August, but it's still below the BSP's target range. So it does give them a little bit of flexibility, I guess, whether they want to think about reducing rates later this year. They've got 2 meetings left. We had the interview with the BSP governor just a few days ago telling us that maybe it's on the card, maybe not, but they do have 2 opportunities until the end of the year. Asia ex-China, I mean, it is that big focus on the jobs report coming up later today. We've had the private payrolls data. We've had the JOLTS data as well, and that really does point to weakness. So, I mean, a 25 basis point cut later this month from the Fed is pretty much baked in right now. Maybe if you get a huge inflation upside surprise, that reading is coming up in a few days' time. Maybe that's something that could tempt it, but generally that course for easing appears to be pretty set right now. You've got the 2-year yield back down to around a 1-year low, but also just taking a look at yields generally moving lower across the board, and equities a bit to the upside.
Yeah, those 2-year yields are basically the lowest of the year right now, right? As we continue to pile on those bets there that the cut could be coming as soon as this month, right? So certainly that is going to be the case. I think the number to watch is 75,000, right? And the revisions, right? If we see the same sort of revisions that we saw the previous month, does that sort of add to more sort of concern in this market that, this labor market is cracking and maybe deteriorating faster than we thought? That was what triggered a lot of the repricing last month as well. And unemployment, right? That number is supposed to be of 4.3%. That's the highest we've seen in 4 years. So certainly there's going to be a lot to watch out for in this print on whether it actually does justify the pricing that we're seeing right now.
Yeah. So let's get more with our MLive strategist Mark Cranfield with us this morning. And Mark, what do you make, or what are you expecting for this jobs report? And is there anything right now that can sort of tempt or test expectations around what the Fed does later this month?
Yeah, quite a bit. It's not just about the jobs report. We've also got these interviews that Scott Bessent will be holding with potential Fed candidates as well. But speaking of the jobs report itself, I'm just looking at some of the past data. If we do get confirmation of the unemployment rate rising to 4.3%, then it really looks as though the US dollar has quite a bit more downside to go on the back of that. If you look back over the past few years, on previous occasions, I know the conditions, everyone will say they're not exactly the same as they were before, but the US dollar was much lower. Last time we had 4.3% US unemployment, the US dollar, in terms of the Bloomberg spot index, was quite a bit lower. So even if the market doesn't correct to or exactly the same levels as it was a few years ago, it does suggest that there's a bias towards dollar weakness if we get a confirmation of a soft jobs number today. And of course, if the non-farm payrolls comes on the low side as well, that will just add fuel to the fire. We're pretty much fully expecting a 25 basis points September cut from the Federal Reserve, but really what traders are looking for is where we go beyond there. And some of that will be linked to the interviews that Scott Bessent is holding starting today to see who's the next Fed chairman, but not just for the chairman, because Mr. Bessent has also indicated that all of these are potential candidates to replace Fed members who will be due to be retiring next year. So everybody is in the frame here. They're likely to have quite a bit to say about what they think about monetary policy. And most of it, I think traders will be assuming, is going to be in line with the thinking of the White House administration. So all of that, if you put it together, it is certainly a reason for traders to be a bit bearish on the US dollar.
China, I mean, we're seeing a bit of stabilization here today. You've been tracking what's been going on onshore. Have we seen enough that we could see some sort of floor moving forward here? Or what to look for next, Mark?
I don't think the Chinese authorities will be fully satisfied with just one day of a correction lower in the equity. If you look at how they've behaved in the past, when they've talked about too much speculation in the markets, they've expected to see the market go down for a few days probably. So if traders don't do it themselves, if we see the Chinese equity markets generally a little bit higher, I suspect we'll hear a bit more from the Chinese authorities to remind them that they do need to cool their heels a bit more than they have done already. So I suspect this is not the end of the story. I think that things have changed from 10 years ago when they took a very heavy-handed approach to trying to quell speculation in the markets. That didn't go down very well. I think they've learned their lessons from there. Plus, the Chinese economy is not as strong as it was back then. Financial conditions are not as easy as they were. The PBOC is doing its best to provide liquidity, but still, there's still risk of deflation in China. So the authorities will tread more carefully and gently than they did in the past. But I suspect they'd like to see the market come down a little bit more than it has this week.
Mark, thanks so much for joining us. That was our MLive strategist, Mark Cranfield, there in Singapore. And just as we've been speaking, we've actually had a breaking news headline crossing the terminal around Xiaohongshu. This is the social media app that's known as Little Red Note or Little Red Book outside of China. But it has, what we are expecting is for its profit to triple to $3 billion. I mean, this is one of the best known social names inside China. It's not a listed company, but certainly we have seen their valuation continuing to grow. And also really testing the likes of Douyin, for instance, in mainland China as well. I
think the valuation has surged to, $31 billion in recent transactions. They have a lot of partnerships, of course, with some of the e-commerce platforms like Alibaba, and really become a source of news as well, right? People don't really go on Weibo anymore, right? It's more about really what they see on Xiaohongshu as well. 300 million monthly active users here right now, which goes to show, right, there's still plenty of talk here about the commercialization. And then, of course, are they going to be listed and where? Certainly.
Well, we hope Hong Kong. Just
I'm sure Hong Kong Exchange is looking at that.
Hong Kong is looking at
well.
that. We know that one, but we'll see. We'll see.
I mean, this market maybe needs a bit more liquidity, right? If you take a look at what we've been tracking, right? And it's interesting what we heard from Morgan Stanley's Robin Xing about, the takeaways that he had from his trip to China and really what policymakers are saying, right? And he kind of phrased it in a very poetic way. Take a listen.
I think policymakers probably see the equity market as a very, very excitable dog on a very long leash. So it does, on random directions. But eventually, the policy guardrails, which is the leash, can bring it back. So what happened over the last 2 months, the debate over liquidity-driven market, the so-called deposit migration thesis every speaker on your show mentioned, I would taper expectations because the size of this excess saving in the last few years is probably smaller than most people imagined.
Let's bring in Winnie Wu, a China equity strategist at BofA Securities. And Winnie, thanks so much for joining us this morning. So, I mean, we just heard that from Robin Xing talking about how it's a equity market that's on an excitable dog that's on a very long leash, but the rails are there in place also to guide where it goes. I mean, what's your take on that?
Yeah. I mean, if we look at the various metrics like margin financing as percentage of daily turnover, like the market velocity, there are signs of overheating since mid-late August, right? Margin financing reached around 12% of daily turnover, which historically is sort of a red line. So, that's something I think will make regulator a bit nervous, and especially when certain sector stocks were like doubling, tripling year to date. This kind of big moves could lead to not only money-making effect, but actually money-losing effect if retail investors rush in toward the end of the rally with leverage, right? It actually can destroy more value in retail investor than creating value, as we saw in the previous boom-bust cycles in 2015. So naturally, regulator want to cool it down. Regulator want to caution, right, the excessive leverage, so to speak. But I think the regulatory intention is to still cool down the market, not crash the market, right? And also thinking of the next month or two, there's the Fed rate cut, and in China there will be the fourth plenary session, and there will be the 15th five-year plan coming into 4Q. And typically, market will still have a more constructive, positive bias ahead of these political events. So I would say, yes, in the short term, is one-day correction good enough? Maybe not, right? We probably need to see a bit more, but the correction is not unlikely. If it's purely driven by regulatory warning, it's unlikely to be a very deep correction in the short term, given we still have this political event to watch for in October.
Do you expect more then of some more heavy-handed intervention, or have you been kind of burned in the past too?
There are market whispers about window guidance last week already, and apparently if it didn't work last week, we get a bit more this week. So I think that's always possible, but will there be more harsh measures? I doubt it.
Okay.
Where do you think the equity market goes from here then? I mean, we've been speaking as well about earnings season. Yeah. It wasn't so great. Is there enough then to be tempting investors back in?
Yeah, I mean, that's an interesting debate, right? From our China perspective, MSCI China valuation now 13 times, which is above the normal zone. And, many China investors or people look at China for long would say, are we in the bubble-ish market? Is the market already deviate from fundamental? But when you look broader, this kind of liquidity-driven rally is not only in China, right? I mean, you look at Europe, you look at Japan, Taiwan, Korea, U.S. Liquidity is very abundant everywhere, and many market valuation multiples now are higher than beginning of the year. So it's not only a China phenomenon, one. And two, earlier this week we published an in-depth thematic report on how AI will reshape the equity investment horizon. And one point we made is, for the longest period, market would, for the longest period, labor cost is a very important driver to GDP. So equity market tend to be more constructive on countries with young and growing labor force, like India, Indonesia, right? Whereas countries with aging, shrinking population, China, Korea, Japan, are considered as a structural challenge and see valuation discount. But when we looking ahead, think about how AI is going to reshape labor force, right? Automation already replacing the assembly line operators, but agentic AI is increasingly replacing knowledge workers. Then maybe labor cost is no longer such a big determination factor, but instead tech-advanced countries, tech-savvy countries like China, like Korea, might be better positioned to take advantage of AI, which they may be able to drive faster than expected long-term GDP growth, and that's enjoy a multiple re-rating, right? So I think, in terms of the valuation, even though we currently, for the past 2 months, there are signs of overheating, especially in sectors like AI. I see you show the chart, right? China CSI AI index valuation multiple re-rating 45% in 2 months.
Right.
That's probably a sign of overheating. But taking a 3-year view, I think AI could be quite positive, structurally positive on China.
We've seen a bit of that rotation away from semis, right? It's more like infrastructure, it's more of adoption right now. I mean, is that sort of where you're looking at in terms of how to express this now?
Yeah, very interesting, right? Initially, in the past 1 or 2 years, the focus is all about computing power, it's about GPUs, because that was still at the theoretical stage of AI, looking at large language model. But now, at least in the United States, we see AI really being mass adopted and people start to do this mass capex. So increasingly, it's got extended to both upstream in terms of the infrastructure, right, the power, electricity, the cooling, and the downstream in terms of physical AI, when AI brings into humanoid robots, autonomous vehicles. And in the computing power phase, looks like China faced a lot of challenges because of the chip ban, export controls. But even on that, I think China was able to making the headways to narrow the gap on technology rather than widen the gap. But also in the upstream of power electricity, call China's overcapacity or strategic overbuild. China actually does not have the constraint or much less a problem in constraint in terms of electricity supply, power supply. And China is exporting a lot of these liquid cooling equipment, power equipment, right? Also on downstream when it comes to robots and AVs, China's ability to mass produce these products, good enough quality, but affordable robots is also, unparalleled globally. So I do think that, investors are now looking broader, not only look at, the GPUs, but also what does AI really means for the broader side of the supply chain.
All right, Winnie, we'll have more from Winnie Wu there, China equity strategist at BofA Securities. We're just starting to really kick things off with her whole AI report there. Still ahead, we're going to talk about Thailand. The parliament there preparing to pick a new prime minister after the ouster of Patuktar Shinawat. We have details coming up. This is Bloomberg.
All right, let's bring back Winnie Wu here, China equity strategist at BofA Securities this morning. We're seeing some upside across the board in equities today, but also a big focus on China in particular, because we had that Bloomberg scoop yesterday around looking at measures to maybe try and cool the equity market rally. But today, again, still a little bit high. But Winnie, we were just talking there in the ad break around AI. It's around innovation that we see using AI across a broad range of sectors now. And some would say, that's really where China is actually getting ahead of the US. It's at the application layer and how it's really becoming quite widespread in terms of adoption now.
Yeah, and I think, earlier this year, I said DeepSeek moment for China is like the Baba IPO moment, right? It's really reshaping how equity market, how the world think about China in terms of its animal spirit, its innovation capability. Because the narrative in the past 2-3 years is that, animal spirit is dead in China, Chinese people are lying flat, and China's going to miss out in the AI age. But I think from DeepSeek, we saw more DeepSeek moment across broader sectors, right? Whether it's humanoid robots, whether it's in innovative drugs, biotech area, or in the application area. I think, private companies in China this year really showed that they are still driving innovation, breakthrough technologies, and this is going to be the driver for productivity for China over the long term, right? So the question of whether China is investable, I think, become clearer. That in the past year, maybe people say, we trade China, buy the rumor, sell the fact. But this year looks like if China can continue to drive innovation and if China has an edge in the AI application adoption phase, then maybe there is really a long-term structural story to buy China because of the continued productivity gain from this innovation in the AI age.
And that's, it seems like, right, market participants are not really focused on fundamentals anymore, right? As you say, right, it's more of a tactical sort of play on these emerging trends like robotics, like rare earths and the like. In terms of what could lead and drive this rally, then, is it still going to be the innovation side, the biotech sector, which is still the leader among the board? Are those still going to be the leaders by the end of this year?
Yeah. So this year, one interesting thing is we see a lot of rotation very fast, right? From February, we talk about DeepSeek. March was humanoid robots. Then second quarter was banks. And then was innovative drugs. It was new consumption. Then July, it was a stable coin, anti-involution, and now back to AI. The themes are rotating very, very fast. Right. So from our perspective, the distinguish is that if there are earnings to support, right, like we see in some of the innovative drugs, we see certain leaders in the new consumption theme that are really delivering on the earnings. I think those themes can support, right, because, share price might overshoot, have a pullback, but as earnings deliver, valuation makes sense again, share price can have another leg up. But for stocks that's purely buying on the dreams without delivering the earnings, then for institutional investor, at least long-only investor, we don't advise them to chase because these themes rotate too rapidly. By the time you jump on, it might already be at the end. So generally, our view is we are still constructive on China, at least for the next 1 or 2 months, we say buy on the dips. Yeah. But we'd rather accumulate these structural trends on the low, whether it's AI, autonomous vehicle, robotics, or new consumption, innovative drugs, accumulate the companies with earning growth on the low, right, rather than chasing the meme stocks on the high. And on that, next week...
You have your conference, yes.
Yes.
Please tell us about it.
Yeah, it's our first APAC conference. It will be in Hong Kong. We have nearly 1,400 investors registered, which is the biggest ever. And AI will be a very big theme. We'll have 2 tracks, one on the AI infrastructure side and one on the AI implementation adoption side.
All right, we look forward to it. Winnie Wu, thank you. China equity strategist at BofA Securities. Plenty more ahead. This is Bloomberg. Another story that we're tracking in Southeast Asia is Thailand's parliament is expected to vote for a new prime minister today. The main opposition party has agreed to support rival leader Anutin Charnvirakul as the next prime minister.
Yeah, let's get more on that now. Bring in Bloomberg's Patpichka Tanakas and Pete Pat in Bangkok, rather. But Patpichka, what can we expect then today from the vote?
The parliamentary vote that is set to begin momentarily is going to look like a showdown between 2 candidates, Chaikasem Nitisiri of the ruling Pheu Thai Party and his challenger, Anutin Charnvirakul of the opposition Phum Chai Thai Party. But the reality is that Anutin's victory is almost certainly in the bag. He has cobbled together a coalition of 146 lawmakers out of almost 500. But the key to his success will be the support, the one-time conditional support from the People's Party, the largest party in the parliament. His win will cap days of political uncertainty that was unleashed after Prime Minister Paetongtarn Shinawatra was ousted by the Constitutional Court last week over ethical violations. But under the conditions set by People's Party, Anutin will only lead an interim minority government for only about 4 months before he dissolves parliament and calls for new elections.
Okay, so during that 4 months of power, what has Anutin promised? What can he achieve?
People's Party said that the deal with Anutin was essentially to elect a prime minister who would bring Thailand out of the short-term political crisis. So to get there, they have set a list of conditions that Anutin already agreed to. And firstly, Anutin would need to dissolve the parliament within 4 months of taking power, which would trigger a process to hold an election within 60 days. Anutin is also required to hold a referendum to amend the constitution, as well as try not to try to become a majority in the lower house in the meantime. And that is precisely how the People's Party aims to maintain its leverage over Anutin, because it intends to stay in the opposition and not join his government, so it can threaten to raise a vote of no confidence to oust the prime minister that it helped elect if Anutin fails to keep his promises.
Papicha, thank you. Papicha Tanakas and Peep out there joining us out of Bangkok, and we'll leave you with those live pictures from the Thai Parliament. Plenty more ahead. This is Bloomberg. 11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break, and we're seeing a pretty decent rally on the Nikkei here right now. So equity markets are bought up here. We're more than 300 points to the upside on the Nikkei. The yen is also stronger here as well. We're watching the bond space. Looks like we are coming off some of the highs of late on the long end when it comes to where those yields are. So we're down 2 basis points for your Japan 10-year yield. That was after we saw a pretty smooth 30-year bond auction yesterday as well. We also did see those wage numbers coming through earlier this morning, which was actually seeing some punchy gains, right? 4.1% in nominal wages. That's the biggest thing they've seen in mostly 7 months or so. So that does back the case for rate hikes again, but the bond market not too concerned about that data just yet today.
Yeah, it's actually for a market that's had 2 big bond auctions and then this data as well. It's coursing along. But let's also take a look at what's happening in Asia, broadly in Asia this morning, because we are seeing equities here that are moving to the upside. I mean, it was a pretty strong day on Wall Street again overnight. Lots of expectations around Fed easing that continue to build. We had the private payrolls data. We've got JOLTS data as well. All of that's really setting the case now for a Fed rate cut later this month. Where we are seeing some of the bigger gains, IT space, for instance, at 1.3%. But lots of stories really around DeepSeek in particular, and sort of more optimism around agentic AI and the capabilities that they're also building that we already see from peers in the US, for instance.
Yeah, I have to learn how to say agentic now. That's my new word for the week, for the year maybe. Yeah, let's look at more on that DeepSeek story. It's said to be developing a new model with advanced AI agent features to compete with US rivals such as OpenAI. Now, sources say the model can execute multi-step tasks with minimal prompts and learn from actions. They also say founder Liang Wenfeng is pushing for a fourth quarter unveil as the industry awaits a successor to R1, which, of course, rattled rivals earlier this year. Let's bring in Bloomberg Intelligence. Robert Lee, he says DeepSeek's planned model should help it catch up to the likes of Alibaba. Our senior analyst is with us right now. So what did you make of this sort of update on DeepSeek? Was there much of an update?
OK, it's an evolving story. So, as you said in your intro, DeepSeek made headlines back in January with its highly innovative, low-cost R1 model. The company actually launched prior models to that at the end of last year, but we can talk about that another time maybe. So the update to R1, referred to as the R2, has been highly anticipated in the market. It was scheduled, apparently, for release in May, but that was delayed. So I guess part of the story relates to the reasons behind that delay. Again, unconfirmed, but it looks, obviously, because the CEO sets a very, very high bar, a high standard. He's looking to add agentic functions to the new model in order to try and catch up with the likes of Alibaba, etc., which I'd say arguably have got a lead on them at the moment. And then secondly, there were earlier unconfirmed stories that it was the ongoing shortage of AI accelerator chips in China which caused this delay. Exactly, where the truth is, we don't know. There's probably truth in both of these stories.
Just let's pick up on that theme around competition with Alibaba. I mean, why is it that you think Alibaba's out ahead, and where is DeepSeek positioned then competitively in the market landscape there, but also against peers in the US?
Okay, third-party data says it. So one of the main benchmarking services that we follow is called LiveBench. So we publish a regular product on a terminal looking at the monthly data. If you look at the data for August, Alibaba was the only Chinese LLM to rank in the top 15. It was a list that was completely dominated. If I recall, 9 out of the top 15 spots were dominated by OpenAI. Now, having said that, two things. The gap between the performance of all these leading models isn't particularly high. So it's not as if the performance of OpenAI, good though it is an order of magnitude greater. So that's the first thing. And then the second thing, these performance tables are very volatile. So even though most Chinese bots have dropped out of the list this month, let's wait and see. I think, we keep the faith. China, there's clear evidence that China, it's a two-horse race between China and America at the moment. And Chinese AI engines and chatbots are, extremely competent.
I mean, is DeepSeek ever going to make money? That's one question. And will we ever see an IPO at some point, too?
Yes. I think similar to OpenAI, was set up on altruistic, almost charitable basis in the early days, although, again, that's an ongoing saga and debate. The same applies to DeepSeek. So I think, their primary purpose that they see, and the CEO has said this on the record, is to help seed the technology, help proliferate it within the broader economy, and that certainly ties in with what the government is trying to do at the moment. So it does charge for some services, particularly API access, but I don't think it's a profit-seeking company, and therefore, if that's the case, it's probably less likely at this point, unless it completely changes its focus, that it would come to market. There are other more likely candidates. Let's even see if Manus does.
Manus, yeah, now, of course, re-domiciled in Singapore, though, and more of a global focus as well from that company as well. That was our Bloomberg Intelligence analyst there, Robert Lee. But let's stay on China and talk about the social media firm Xiaohongshu, because we had this breaking news earlier. The company's looking at giving a rosy full-year projection, telling investors that profit could triple this year. Earlier as well, we reported that its valuation had surged to $31 billion. Our asset allocation reporter, Echo Wong, joins us now. So you were on that report yesterday about this surge in valuation to $31 billion. But how should we think about that change, and also the profitability question as well?
Right. Just remember, this is one of the leading Chinese internet companies that still remain private these days. So a lot of these valuations and profits are, what the company tell the investors, right, per se. So obviously there's a lot of excitement in terms of, how through a funds transactions, LP stakes transactions, that we are able to capture the sort of latest development of Xiaohongshu, which is sort of like the analog for Instagram these days in China. There's a lot of excitement about it to be a public listing company even. So obviously it reflects a broader trend of investors' excitement of the China internet space.
Yeah, it seems like we're seeing those animal spirits, right? I mean, what does the valuation tell us about sentiment overall in the China tech investment space?
Obviously, just looking at the Xiaohongshu example, right? Its valuation surged literally from the same fund that we track since the first quarter. It surged 19% in 3 months' time. So obviously, investors are giving it a lot of confidence in terms of where the company is going. And if we think about the profitability of the company, that's on track to also double from its 2024 $1 billion. Investors are paying a lot of attention in terms of, how this platform, which basically people these days use it as travel guidance, influencers sell all kind of goods on it. They're betting on this model to work. And there's a lot of expectations as well on the China consumer space. So I think it plays into a bigger story on the tech plus consumer space.
Echo, thank you, Echo Wong there, joining us there on Xiaohongshu. Coming up, China pledging closer ties with North Korea after Xi Jinping hosted Kim and Russia's Vladimir Putin at a military parade this week. We have details coming up next. This is Bloomberg.
Some of the stories that we're tracking this morning, well, European leaders are pledging to provide security guarantees for Ukraine if a ceasefire takes hold. France says 26 countries are ready to contribute to guarantees, including troops. President Emmanuel Macron says US support for the measures will be finalised in the coming days, although the White House didn't comment. Sources say President Trump will rename the Department of Defense to the Department of War. It's a moniker that's been used, or not been used rather, since the 1940s. Trump is expected to sign an executive order on this on Friday. The changes include renaming the Pentagon's briefing room to the Pentagon War Annex and modifying the department's website and signage.
All right, time to look for what's trending in China. Look what's making headlines in domestic media. And state broadcaster CCTV is reporting on President Xi Jinping's call for international cooperation on AI, saying it is a global public good. In a letter to the World Intelligent Industry Expo in Chongqing, Xi said that China is willing to work with other countries on AI governance frameworks and technical standards. But Xi's meeting with North Korean leader Kim Jong Un is what's dominating media coverage today. The reports say they reaffirm their country's long-standing relationship and pledge to safeguard their common interests. Now, a photo of their handshake, there you go, is displayed prominently on the front page of the People's Daily, along with Xi's meeting with other world leaders and really highlighting a busy, busy week when it comes to diplomacy.
Absolutely. I mean, you sort of go from the SEO, for instance, right into the military parade, and it's been quite exceptional, really. I mean, you had Xi's meetings, for instance, with Vladimir Putin, Narendra Modi, Kim Jong Un. I mean, widely shown as a show of defiance against the US.
It's hard to steal the spotlight away from President Trump, but I think President Xi won this week.
It, yeah.
Even got the president of the U.S. to talk about it, right, and tweet about it. So he was also watching as well. But yeah, those really remarkable scenes, like this one, right? The hand holding, the hugging between the likes of Modi, Putin, and Xi was really what dominated the headlines here, and really kind of signaled where this whole world order is going to look like, and the shifting of that here when it comes to energy security, right? You talk about the energy deal between Russia and China that came out of this week as well. The integration we could see economically between all three of these nations as well. And it really bodes the question of alternatives to the U.S. dollar and the like. So certainly, is it a strategic reset? People keep questioning that. Or is it something that's more tactical against what we've been seeing with is a U.S.-led world order?
Yeah, absolutely. And I think that was sort of, as you said, one of the key takeaways was that energy that you saw, the new deal around the pipeline, for instance, from Russia into China. I mean, Russia's been pushing back on that for a number of years, but managed to get it across the line. Here, I mean, if you were to talk about any big moment away from the week, it was the hot mic moment as well.
Organ transplants.
Organ transplants, living to 150.
Immortality.
I mean, it's all possible. And it certainly, of course, is always, when you put in those questions like lowering term limits, eliminating term limits, family dynasties as well. I mean, it's all really in play. But China's military parade, of course, where we had that hot mic moment on Wednesday, was very carefully scrutinised. That's after President Xi moved to purge nearly a fifth of the generals he's appointed. That topic is the focus of our weekly doc and how the shake-up could reshape China.
This is the world's largest military.
An elaborate military parade showcasing new weapons, really a show of force for China on the global stage.
Xi Jinping has made it a stated goal to modernize China's military and turn it into a fighting force capable of winning wars.
But behind the choreography, it's undergoing its most serious leadership shakeup in decades. During Xi's third term, 15 of the 79 generals promoted under him have either gone missing or been investigated. It's the biggest purge of China's military personnel since the chaotic Mao Zedong era ended in 1976.
Every time you think, surely this is as big as it can get and as high as it can go, it does seem to just keep getting bigger.
He obviously wants to centralize control, even at the expense of having people that he himself has personally appointed removed from that party structure.
This is key as Xi nears a potential fourth term that would stretch his time in power to 20 years. The global consequences will be far-reaching, with tensions between the US and China rising on many fronts. And then there's this.
A top U.S. admiral says signs suggest China is sticking to its ambitions to be ready to invade Taiwan by 2027.
The competition between the United States and China is the most dangerous and the most impactful when it comes to the militaries of these two countries. Anything that changes the dynamic there is inevitably going to change the way the world works politically, economically, technologically, in big and small ways.
Yeah, that was just a snippet. Subscribers can really watch the documentary in full right now on the terminal or at Bloomberg.com. It'll be available later on the Bloomberg Originals YouTube channel. It kept me hooked. You got to watch the rest of it. If you're a subscriber, you want to watch that interview, of course, and everything that goes on in our shows. Our TV function there, TV Go, is where you go. You can become part of the conversation, send us instant messages, questions for our guests throughout the show. Check it out at TV Go.
Well, President Trump's nominee for the Fed's Board of Governors, Steve Miran, has pushed back against Democratic concerns that he would do Trump's bidding at the central bank. Bloomberg's Mike McKee has the latest from Miran's confirmation hearing in Washington.
The potential new Fed governor has a mostly traditional economic background, a PhD in the subject, experience at Treasury and the White House. But Stephen Miran is not a conventional candidate for the job. He would come to the Fed as a full-throated supporter of President Trump's economic policies, especially tariffs. Miran told the Senate Banking Committee he would leave those views at the White House.
I couldn't be more in agreement that independence of the central bank is of paramount importance for the economy, for financial markets, for the long-run stewardship of the country.
But Senate Democrats weren't buying it, noting that Miran has proposed significant reforms to the Fed that would give the president more control over monetary policy.
So let me ask you the question for the third time. We want to understand your independence. Donald Trump stated that the BLS faked the job numbers before the election to try and boost Kamala's chances of victory. Do you agree with that, yes or no?
The Bureau of Labor Statistics did not take corrective action to improve the quality of steadily deteriorating
Do you agree
data.
with the statement that they faked numbers?
Miran also raised hackles when he told the committee he would not quit his job at the Council of Economic Advisors, simply take an unpaid leave of absence and return to the CEA when his Fed term is up. That would be the definition of a revolving door, as he would still be an employee of Donald Trump while making monetary policy decisions supposedly independently.
Your independence has already been seriously compromised by a statement. You are going to be technically an employee of the President of the United States, but an independent member of the Board of the Federal Reserve? That's ridiculous.
In the end, Miran was singed but not burned. Republicans have a 2-vote majority on the Banking Committee, and Miran's nomination is expected to be approved and sent to the Senate floor, perhaps as early as next week. Michael McKee, Bloomberg, Capitol Hill.
And that was Bloomberg's Mike McKee reporting on Stephen Miran's confirmation hearing for the Fed's Board of Governors here. Some of the political stories that we're tracking today, Bloomberg has learned that the U.S. Justice Department has opened a criminal investigation into whether Federal Reserve Governor Lisa Cook committed mortgage fraud. Sources say federal prosecutors have issued subpoenas seeking information related to the allegations. Last month, Trump moved to fire Cook before she sued the administration to stay on the job and maintained she never committed mortgage fraud. India and Singapore have signed new deals to deepen cooperation in AI and semiconductors, along with agreements in shipping and aviation. During his visit to India, Singapore's Prime Minister Lawrence Wong said skills centers and R&D links are also coming. The visit comes as U.S. tariffs rise to 50% on Indian imports, prompting New Delhi to seek expanded trade ties. The Financial Times is reporting Anthropic will stop selling AI services to groups majority owned by Chinese entities, including ByteDance, Tencent, and Alibaba. The report says it's because Anthropic is trying to prevent Chinese tech from benefiting its military and intelligence services. Sources told the FT that the policy will take effect immediately.
Taking a look at how markets are going this morning, we are just nearly 90 minutes into trade so far, and we're seeing some modest upside for Chinese equities. I mean, I think the big question, well, actually not so much for the sub-indexes there. You can see the Chinex, for instance, at nearly 4%, but of course one of the biggest sell-offs yesterday in the session. I think the question, though, is this going to be something that regulators want to see, or do they want to see more of a pullback because there's been a lot of concerns about the health of the rally and whether that was looking sustainable or not? Yeah, one day of selling may not be enough to assuage, of course, the policymakers and the like here, right? As you see, right, Shenzhen is still once again on a tear, once again up 4%. The Star Board is also up 1.5% as well. So you are still seeing some incremental buying when it comes to those big, darling stocks like Capricorn here this morning as well. You take a look at how CGBs and how they're looking here this morning, given the fact that there is a CGB sale here today and not much movement, but you are seeing the 30-year yield at least tick slightly higher. We're just up about 1 basis points for that 30-year yield, just above that 2% level here as well. Sun Hung Kai, of course, just reported earnings there, and they were a bit of a disappointment. The stock is down some 1.5%. So that share, the properties there, SHK, on the weak sales target that came through from the developer here this morning. In terms of what to watch for the Hang Seng here as well, obviously we've been tracking a little bit of stabilization there as well, right? We're up about 2/3%. Obviously, it seems like onshore is doing a little bit better than the offshore markets here today. But then again, we still have a lot to look ahead to for the next couple of hours. The U.S. jobs report. We have, when it comes to inflation numbers in China and the like, of course, and also inflation out of the U.S. as well next week. Yeah, I mean, I think the big one, obviously, coming up next is the U.S. jobs report. I mean, we've had so far the payrolls data or private payrolls data. We've had the JOLTS data as well, and that's really been on the weaker side. So is what we get in the jobs report today going to further build that case in for a Fed rate cut later this month? I mean, certainly we've seen bond traders, currency traders really bracing for it, but also probably looking to solidify views more than anything else. It's going to take really a shocking number, I think, to unseat these views around easing. Estimates for 75,000. I think anything sub 50,000, that's when you start to worry that it's not just about this kind of Goldilocks scenario where it's a slow deterioration in the labor market. It starts to bring up concerns about stagflation and the like here. But certainly that's going to be one to watch, right? I think one analyst put it very interestingly. The Fed's free pass on the labor market has ended. Because ever since that last jobs report, I think the market has significantly shifted the focus now in terms of the labor market over inflation. Yeah, that's right. I mean, we had the calls also coming out of the Fed New York Bank president, John Williams, saying that it's an appropriate time to begin easing, but also just talking about it's a really delicate balancing act. On the one hand, the Fed does need to look at the jobs market, but they also need to take a look at the inflation risks and the risk of anything being too restricted for too long. That also increases the risks to the employment picture as well. Yeah, so that's going to be one thing to watch in particular here. I think there's interesting surveys about the reaction we might see. I think it's pretty split, right? I think 22V Research came out with a survey there. I think it was like 36% expect a risk-off reaction from this jobs report, 35% mixed, and then risk-on is about 29%. So it could really go either way. So certainly that's the big thing to watch in the next few hours as well, and really how this kind of shifts the dynamic among the Fed. Of course, you mentioned Waller also was the one that talked about multiple cuts to end the year. So certainly the market is pricing too. How much more could we see in terms of that, the market pricing and how much that could shift? Thailand markets are opening up in the next hour, and certainly watch India very closely as well. But, we are right now underway this voting process in the parliament for the new PM. And Anutin, of course, has been slated to possibly be the winner in this and be the next prime minister. And it's certainly we've seen a revolving door around that as well. Yeah, I mean, we're talking about the third prime minister in 2 years for the country. So certainly it has been a period of political upheaval. But that big question, who would be replacing Pai Tong Tan, Shinawat, I mean, it should be answered really